Depending on your LVR, LMI could be an extra cost. Did that sound as confusing to you as it did in my head? Let's break it down. There's no denying that saving for a home loan deposit is a monster of a task. Plus, on top of your deposit, there's quite a few extra costs for you to fork out. Now, depending on how much deposit you have, LMI could be one of these costs. Now, you're probably thinking, again with the abbreviations, what on earth does it mean? Don't worry, I'm gonna break it down for you and I'll explain why it's important. Hey guys, this is Fabian from the Lending Lab. This video is sponsored by me because it's my video and we can do what we want. Now, before we dive in, disclaimer time. This is general information made to educate you and it's not tailored to your individual circumstances, your goals or your needs. You should speak it to a professional like me to get individual advice before you make any decisions. All right, so LVR is one of the most critical numbers for buying, investing, or refinancing a property. It stands for loan to value ratio and is expressed as a percentage. So essentially, it's your loan value divided by the value of your home. Let's do some math for you. Let's say you have a property and it's worth $500,000 and you have a loan on it for $400,000. You have an LVR of 80%. Now, if you have the same property worth $500,000, but it has a loan of $450,000, you have an LVR of 90%. Your LVR is important because it determines whether or not you have to pay lender's mortgage insurance or LMI, as I so cryptically said before. Now for the banks, if you're only borrowing up to 80% of the value of your home or your LVR is 80 or below, then it's happy days. You've got a really healthy deposit and it's low risk for the bank. Now, if you do want to borrow more than 80% of the value of your home, the banks can get a little bit nervous. This is because if anything goes wrong, if you go bankrupt, the market isn't favorable, they could lose money. Now, they don't necessarily say no to your loan, but they do err on the side of caution. Q LMI. It's an insurance policy that covers the bank if you end up defaulting on the loan. Important to remember that it covers the bank. It doesn't cover you. So if they lose $20,000 or $30,000, they'll get paid by the insurance company. So why is this important? Well, for LMI, it's paid for by the customer, being you. Now, it can get a bit pricey and estimates are going to depend on the exact size of the loan and the home you're looking for and your circumstances. But banks being banks, they all charge different amounts even for the same customer. So if you want to get an understanding of exactly how much you need to pay and how much deposit you might need, you need to speak to a mortgage broker like me. And they can give you an estimate based on different scenarios and help you understand exactly what you're up for. Now, there are some ways to get around paying LMI, like having your parents go guarantor, or there's a government program currently called the First Home Loan Deposit Scheme that can help buyers get into their home without paying LMI. But that's for another video, and that's all the time we have for today. Now, if you did find this valuable, if you learned something, let me know in the comment section, hit the like button, do all that YouTube stuff that we love, and I'll see you in the next one.